This is a brief lecture over Chapter 7, Bonds and Their Valuations. The overview of this chapter, the key features of bonds, bond valuation, measuring yield, and assessing risk. What is a bond? A bond is a long-term debt instrument. It has very specific characteristics. The first is a par value or face amount. We assume for corporate bonds that $1,000 is that amount. There is a coupon interest rate. That coupon interest rate is part of the initial issuance, and it is a rate that will be paid as a percentage of par value. There is a maturity date, which is when the bonds expire, meaning that the principal is repaid and the bond concludes its life. The issue date is the beginning date, and then the yield to maturity is the rate which can actually change over time. Other features or bonds, there's convertible bonds, there's warrant, which is a long-term option, warrants, or what we saw even before a robust derivatives market, and we see these other forms of bonds which also exist. It is important to note that many bonds have what we call a call provision. A call provision is when a bond is able to be paid off early or before the maturity date. And so because of this, it is important for investors to know when that may be, because they may not receive the fixed income over the full life of the bond. Another thing to consider is if the bond has a sinking fund. The sinking fund is established by the issuer of the bond to make sure that there is sufficient money to pay off the principal, because bonds are interest only, meaning that there is no principal paid during the life of the bond. It is only at the end of the bond. So when we are looking at rates as it pertains to bonds, there is a very important concept called the discount rate. Of course, the discount rate, if we remember back to Chapter 5, is relating to a present value, and what you discover is that the value of the bond is the present value of the future cash flows, those future cash flows being all of the future interest payments to be paid. We see here 10% of $1,000 is the $100 per year, and the maturity value, the $1,000 of the principal amount being repaid. And so what we see here is that if we have a bond that has $1,000 par value, and there is a 10-year maturity, and there are annual coupon payments of $100, meaning a 10%. We also see that the interest or yield to maturity is also 10%. If we were to do that calculation, we would discover that the present value equals the future value. However, for most bonds, this is not the case. And so this is what we need to discover. So we see here, we have what is the value of a 10-year bond that has the same risk but a 13% coupon rate. Well, what we see here is that if it's a 13% coupon rate, then 13% of the future value, par value, face value, $1,000 will be paid each year. We see that the prevailing interest rate is 10%, not 13%. We see the same time period, and so because this bond pays more interest per year at the same risk level as a 10% bond, then people are willing to pay a premium. Specifically, they would pay an additional $184.34 for that additional $30 per year of interest. If the opposite were the case, where we have a bond with a market prevailing rate of 10%, that IR or YR, but the coupon payments were only $70, meaning that it is paying less than other prevailing rates, which would be that $100 at 10%. What we see is that that bond would trade at a discount, meaning that people would not be willing to pay the same as face value or a premium. It would pay a discount, and so investors would only pay $815.66 for that bond. And so this is what creates the equalizer of making sure that all bonds that exist in the market at different coupon rates have the same market risk component, that 10% of the prevailing rate, and so we would see a discount here. So if we were to graph this out, what we would see is that that 10% coupon rate, which would give us the $1,000, the 7% would be much lower than that, the 13% would be much higher than that. When we are dealing with bonds, we need to understand that there are two components to the bond. There is the current yield, which is the coupon payment divided by the current price, and then the capital gains yield, which is the change in price divided by the beginning price. Now, in the case of interest rates being 10% and coupon rate being 10%, there would not be a change in price. As we saw from the beginning scenario, the present value was $1,000, the future value was $1,000. However, in the other two subsequent scenarios, we did see a change in price, and so we would need to identify that. We also see the coupon rate divided by the current price, and this is what gives us that yield to maturity. Even though we did the calculations using an annual rate, most bonds are paid semi-annually. So what does this mean? What this means is that we need to make some adjustments. First, we need to multiply years by 2. So we need to increase the number of periods. Then we need to divide two components, the nominal rate and the coupon rate. That way it balances out what those values are, and then when we bring it back to an annual rate, we would adjust them back. So let's look at this example. We see here 10-year bond, 10% semi-annual, but the yield to maturity is 13%. So we see here that 10%, even though it's quoted as an annual rate, it's 10% semi-annually, so it's 5% per period, which is why we have $50 of the 1,000. We see that the number of periods double, 10 years to 20 periods, and the nominal rate, which was 13%, is now cut in half, 6.5. And so if we do that calculation, we would see a present value, or the market value of the bond, trading at a discount because the nominal rate is greater than the coupon rate, and so we see the discount. Now, another concept that we want to be aware of is how this semi-annual payout affects the interest rate. And going back to the time value of money chapter, we looked at effective rate, and so what we see is that a semi-annual rate actually increases beyond the nominal annual rate. Going back to the previous concepts in this chapter related to calls, what we would need to do is be able to identify a yield to call versus a yield to maturity. And so we see here that the bond's yield to maturity is 8%. So we're going to solve for the yield to call. So what happens within 4 years? So we see here that a 10-year bond, 10% semi-annual coupon selling for a premium. And so what we have to do is dissect this out. So we see that in 4 years, or 8 semi-annual periods, which is what N becomes, that the principal could be paid, but it is paid at a premium, an additional $50 from the $1,000, what we assume as the natural future value or par value. But that payment is still the half of the 10% of the $1,000, which is the face. And so calculating that in and seeing that the bond is currently selling for the price of $1,135.90, what we see is that we would take that calculation, calculate for rate, and we would get the semi-annual rate. And so we see here the semi-annual rate. We then multiply by 2 to get the annual rate. Then we could also calculate the effective rate, which is even a little bit higher than that, which is what we would expect because it is compounding more quickly. Now, because of that, we see here that the coupon rate of the bond was 10%. However, the prevailing yield to call is less than that. So what might happen is the bond issuer will pay off that bond early so they can essentially refinance at a lower rate. A couple other concepts that we need to be aware of. Default risk. We've seen default risk in the prior chapter, chapter 6. It is important to note that bonds for companies reflect risk the same way an individual credit score reflects risk for an individual person. However, instead of a numeric score, we see letter grades, very similar to your academic standing, imposed here. Moody's and S&P are the most common. And what we see in Standard & Poor's, AAA, AA, A, BBB, these are all considered investment grades. High value, low default risk, and then we see everything below that, BB, B, CCC, C, would become junk, and then there is a D category, which is default. So factors that affect that and affect the bond rating, going back to the financial ratios chapter, the debt ratio, the times interest earned ratio, and the current ratio would affect bond ratings. As those ratios deteriorate, we would see a lower debt rating. There's also qualitative factors. We see here certain bond terms, secured versus unsecured. Secured meaning there's collateral, unsecured meaning there's not collateral. Senior versus subordinate debt. The order in which debt is paid off in a liquidation. Also, is there a sinking fund available for which debt would be repaid? Also, the maturity of debt would affect risk. We also see here other factors. Are earnings stable? If they're not, that is problematic. We see other issues here. If a business needs to go into bankruptcy, there are multiple types of bankruptcy provisions, and in our current environment we're seeing those. But what if a company can't meet its obligations? The first step is Chapter 11 bankruptcy, which allows a company to reorganize and allows them to emerge with a different debt structure. If they cannot reorganize and there is not a plan for the company to reemerge from bankruptcy, it would then switch to Chapter 7, which is the liquidation. If a liquidation occurs, there is a priority of claims. So any secure creditors from the sale of secured assets, that is secured debt or debt with collateral, then any costs related to the trustees going through the bankruptcy, any wages that employees have not yet been paid, they need to be paid, then any back taxes, then any unfunded pension liabilities, then unsecured creditors, then preferred stockholders, and common stockholders. This is why common stockholders rarely get anything from bankruptcy proceedings. So this is a brief lecture of Chapter 7.